Hi, it's Brian Jessen speaking with Guaranteed Rate. I'm here to give you a short video about why it makes sense to consider getting pre-approved and possibly owning versus renting. So I have to make some assumptions on both. So I assume rent appreciation was 5% a year, and the same thing on the buy situation. So again, everybody's situation is a little bit different. What you currently rent for, what you may end up buying, be different. But like I said, we have to give an example just to give you some perspective on this. So I started with assuming starting rent of $2,000 a month, and also that you're getting a 5% a year increase in your rent every year, which is kind of realistic. I have a daughter in New York, and she got kind of a COVID deal. It was $1,700 a month. And when she signed her renewal, it was like $2,100 a month. So that's way more than 5%. But again, you gotta start somewhere. So year one, I'm assuming you're paying $2,000 a month rent, then you get your 5% increase in year two, and year three, and year four, and year five. So you're up to $2,430 a month at the end of year five. And the total amount of rent you pay over 5 years is $132,600. And really you're walking away with nothing. If you're lucky enough to get your security deposit back, or any of it, you really kind of walk away with really $0 in your pocket. So that's the renting situation. Now we come over here to the owning situation. And again, I'm making assumptions, have to start somewhere. I'm assuming you're gonna buy a condo or property for $250,000. You're putting 5% down. We have situations where you can put 3% down, you can put more down. But again, you have to come up with a scenario that at least shows the situation. So the mortgage amount then is $237,500. Figure something on the interest rate. I did a 30-year fixed. Then we did taxes. You pay homeowners association dues. You have insurance to insure the things in your unit. The total monthly payment is $2,166 a month. So that stays pretty constant. A little bit of change in taxes and association dues, but pretty constant. At the end of 5 years, you have paid $129,960 versus the $132,600 under the rental situation, assuming that 5% appreciation, which again is not unrealistic as far as assuming places go up 5% a year. At the end of 5 years, you go to sell it, your sale price is going to be $320,000. The good thing about mortgages too is they pay down over time. So part of your payment every month goes to pay the loan down to a smaller amount. So your mortgage balance at the end of 5 years is $219,000. So if you take that sale price, that mortgage, assume normal selling expenses, you will actually net about $75,000, a little over $75,000 on the sale. So you invested $12,500, something for closing costs, and you walk away with $75,000. So kind of in summary, if you look at those numbers, it's clear that over time, owning versus renting is clearly an advantage. And that's what we're here for, to kind of counsel you, give you advice, figure out what's the best purchase price range for you and what makes the most sense for you. So Brian Jessen, Guaranteed Rate. Let's have a conversation. Bye now.